Hi everyone, Joe Eby here. So I thought I'd talk quickly today about what happened this morning, which was the Westpac property breakfast, where they have their chief economist, Bill Evans, speaking about his basically outlook for the foreseeable future. So I always find his insights really useful. He's always very on point and very, direct, basically, in his kind of predictions. He doesn't really beat around the bush, and he gives very clear predictions. He doesn't look to make safe bets. So that's why I always find him pretty useful. So I thought I'd just pass his insights straight on to you and try and relay on the information. I will do my best. I'll probably follow up with a blog post on the Sydney Listings website and on LinkedIn and stuff if we can as well, just to help digest it, because it is a lot of information. It's not all useful to you, but we'll basically see how we go. So I thought I'd start with interest rates, because I guess the conversation at the moment is there's so much happening around the world at once, which is kind of unique for so many different things to be going on. So in Australia, we've seen some interest rate cuts recently, as you will all know. There will be a further cut predicted in October, according to Westpac, and then February again next year. Normally they don't like to make them too close because it can create some panic and lack of confidence in the economy, but that's basically where we're headed. The RBA governor has basically said that they're open to a 0% interest rates at some point, especially if we see America and places like that do it. America's forecasted to cut rates in October, November and December, according to Evans. So that's pretty ridiculous, but we'll just have to see if those sort of predictions come true. It's certainly a lot to process at the moment, but I guess a lot of that is really driven by the unemployment figures in Australia and also the poor wages growth, which is what Evans identified as that real kind of concerning, problematic thing at the moment. That's what's weakening our economy in Australia. So the Aussie dollar is expected to fall in relation to the US dollar further. So they're expecting it to go down to 0.66 to the US dollar next year. They also think the euro is going to fall in relation to the US dollar. Again, there's lots of stuff happening in terms of the trade wars and things like that in America, but they predicted that there wouldn't be a recession in the US, which is good news as long as that's true. So they're not predicting that. The reason a lot of people are talking about a recession in the US is because of inverse bond yield curves, but he's saying that that's representing an attractive investment to international investors. So for that reason, they're not looking at that as a marker that there's going to be some problems in terms of a recession in the US economy. So that's quite interesting. In Australia, on the other hand, so we've had a mixed kind of run with property in the last couple of years. Talking about how commercial property might not be getting quite the rental returns that investors would love to see, but the valuations are coming back favourably for Australian commercial property, especially Sydney and Melbourne. That's going to continue to be very attractive to international people. So that's worth noting. We can talk a bit more about, I guess, Australia and what's happening, especially in relation to property. So we're going to see some more income, household income that is, off the back of interest rate cuts and tax cuts, but that's not likely to go into consumer spending, right? So our consumer spending has been low, but those savings from the tax cuts are going to go likely into people's savings rather into spending more on goods, all right? And that's probably very much related to the fact that we have so much household debt in Australia at the moment. So it looks like it's going to go into servicing that debt, bringing down debt rather than anything else. Talking about, I guess, debt as well and savings. So more than ever before in the last 45 years, people don't think property is a safe investment for their savings. They are leaning to bring their debt down. So that's just the way the households are looking at the Australian market, at the interest rate scene at the moment, and how they're likely to behave, how they're predicted to keep behaving. In terms of our prices, obviously the picture is pretty transparent at the moment. The next couple of months are really going to determine whether we've, I guess, turned a corner for Australian property, especially for Sydney and Melbourne prices. So we've seen the dropping in prices kind of steadied around May, and it's risen 1% since in about 3 months. So it looks like we are headed for stability on that front. We are likely to see that steady out further. In terms of there being rises in prices, so apparently some people in the media have been reporting 10% increases are expected in Sydney prices over the next 12 months. That kind of shocked me that people saying that. Bill talked about that. He kind of knocked that out of the park. He said based around our issues with affordability, that's unlikely to happen. It'd be very hard for that to happen because prices move that fast, they're going to get out of what people can afford pretty quickly, which will then have bad effects. So we want to look at that, and I think the best thing for all parties is steady growth from here, nothing too crazy. We're certainly not set up for that at all at the moment. So unlikely to see massive rises in prices, but steady growth is a good picture for, I guess, the property side of things, especially those in the property sector. Now, a very interesting thing that's always going in Sydney's favour and New South Wales' favour is that net international migration. So there's still a lot of people moving here from overseas. That's always been strong and consistent. Obviously, we're not making any more land, but more people want to live on that land. And that's especially true of Australia. That's what drives price growth over time. So that picture's not changing. Now, important to note, if you're involved in the market at all or affected by price fluctuations, this point's quite important. So the supply of dwellings, so we know that demand is always there from that international migration in, but the actual supply of dwellings, whilst that's slowing down, like new buildings being built and constructed and dwellings approved, that is slowing down, but the point where that demand will really supersede that supply again is likely to be mid to late next year. So that's according to Bill Evans, his team, all their data. I'm inclined to trust that. Certainly don't know any different myself, but that's when that picture is likely to change. Okay, so keep that in mind if you're being strategic about your entry time at the moment. That's what I'd be looking at. The other noteworthy thing, I guess, is that the rental market is still quite shaky in Sydney. So we're seeing the slowest or the worst vacancy rates since the early 2000s. I believe at around 3.3% in Sydney was what was quoted this morning. So you've got to keep that picture in mind. Again, that turnaround next year in terms of supply levels versus that demand and our constant international migration in, that's when I see that rental scenario kind of changing and rents getting better. Not that they're going to go through the roof, but less supply in relation to demand will certainly steady those vacancy rates up. So look, interesting times ahead. Obviously the main concerning thing in like the overall economy is that poor wages growth, because again, that has a relationship with consumer spending, then business confidence, and therefore the whole economy. So we're going to wait and to see for some improvement in that. But in terms of what's happening in property, that picture's quite clear for the next 12 to 18 months, I guess. Unlikely to be some crazy hikes, but hopefully we do see some steady growth. So keep your attention to what happens in the next couple of months, especially in Sydney and Melbourne. September, the spring season basically, is normally a very interesting gauge of where the market's at. We've got those auction clearance rates going up, which is a good sign. So keep an eye out for that. If you want to understand anything further, I'm certainly happy to help you do so. Just get in touch on whatever platform you might be looking at this, and we can always have a chat. That's the interpretation